Okay, we're going to get started here on our journey to talk about one of my favorite topics, which is designing retirement income for our successful clients. And as I was saying a minute ago, it is January 30th. This is our fourth in our webinar series that we just started in December. We're doing this every couple of weeks. Lots of good content. It's been really fun reaching lots of folks. Our passion is for people. We love people, and we want to impact them positively so that they can impact their world the way they want. So, one of the things we say is there is no retirement without retirement income. And one of the first questions I ask folks that are contemplating retirement or even in retirement is, does your family have a written retirement income plan? And they look at me a little dumbfounded and say, no, but that sounds really good. So we found that this marketplace just the financial world does a lot about talking about where to put your money. They don't do a very good job, in our opinion, of helping folks solve problems around retirement. There is a saying that plans fail for a lack of counsel, but with many advisors, they succeed. So that's what we're going to kick off today. I've got our normal disclosures, but we're going to be talking about the real objective of retirement planning today. So we are advisors of Madison Avenue Securities and Singe Advisory Group. Let's get a little disclosure here. So let's kick it off. So, congratulations, you've done a good job saving and investing. And what we say is success creates new risks, not fewer risks. So, the fact that you've had a high income and strong savings doesn't automatically translate into retirement confidence. A lot of the questions our clients have, and not just our clients, but been a lot of studies done about what are the major fears or questions people have around money. And when it comes to retirement, one of the first things is, do I have enough? I think I have enough. I'm not sure. What if I outlive my money? What if I have medical healthcare emergencies that drain my capital? How do I really know with certainty, with all of the things going on in the world, taxes, inflation, market behavior or misbehavior, behavioral finance mistakes, how do I really know I've got enough to do what I want to do to take care of me and my loved ones? So, the real objective, in our opinion, is to provide certainty in our financial lives. So, how do we take net worth to lifestyle security? Reliable, repeatable cash flows, risk containment, lots of risks out there, market risk, tax risk, longevity risk, healthcare risk, etc. And uh, how do we be intentional about the timing of our distributions and where those distributions come from? So we see an awful lot of folks that have fairly sophisticated advisors and portfolios, but they have incomplete plans when it comes for the distribution phase of retirement. So, and I would tell you that most financial firms are pretty good about the accumulation phase, but it breaks down when it comes to really providing solid advice for the distribution phase. That average retirement of about 20, 25 years, folks do not do, in our opinion, a very good job of helping clients do that. They've built portfolios for growth, not withdrawals. They're overexposed to timing risks. They don't know how risky their portfolios are or how bad things could be. They have done a pretty poor job of coordinating Social Security, pensions, 401k withdrawals, private assets, etc. And a lot of them have been focused on tax deferral, tax deferral, tax deferral, but they don't know how to distribute their taxable retirement plans effectively. So, sequence of returns risk is something we talk about all the time here. We say a high net worth problem. It is a retirement problem, in our opinion. What is sequence of return risk? Sequence of return risk is bad market conditions or market declines early in retirement. When we start withdrawals during retirement, if we're in a bad market position, that can permanently impair our capital. And so we don't want any bad periods in the market to ruin a retirement. We talk about the lost decade a lot. That was 2000 to 2009. The S&P 500, if you were invested, if you remember that period, from January 1st of 2000 till the end of 2009, the S&P 500 lost 10% over 10 years. Okay, how can that be? If that was the first 10 years of your retirement, that would be a problem potentially. And we say that stock market averages can't be relied on over 1, 3, 5, 7, 10 years even. 15 years, we're getting out to where we can be pretty consistent with what the markets will do. And a famous investor, Mr. Warren Buffett, when anyone asks him what the market's going to do, he says, I have no idea over 6 months or 1 year or 3 years or 7 years. He goes, over 15 years or 20 years, I know pretty much what the markets will do, what they've always done. That 10, 11, 12% annualized return in US equities. Okay. So why is sequence of return so important to retirees? So most folks have gone through retirement just socking money away periodically and investing, and they haven't worried about the withdrawal phase. During the withdrawal phase, we have time for market corrections to be taken care of, and this slide is really just showing two different sequences of return. So hypothetical amounts or market returns over a 16-year period. The top bar shows sequence of return where we have early positive returns and then negative returns later. If we just flip-flop those rates of return, because we really don't have any control over what's going to happen in the short term in the markets, now we just take flip-flop these sequentially, and we see a period of returns where the returns were low early and up late. That's still an average return of 9% annualized over a 16-year period. That's just math. Okay, that was a standard deviation of about 18%. That's the S&P 500. So two different time period sequences. During accumulation, if you weren't touching your money for 16 years, it wouldn't matter. You'd still end up in the same place. However, now we're talking about the distribution phase. What happens when you have to rely upon your portfolio to provide your lifestyle income? So now we take a starting point of $1 million in year one, and we're assuming we need $50,000 a year annually off that $1 million portfolio, and we're going to increase that $50,000 by inflation every single year because the cost of living goes up. And those two same sequences, what we see here is a 26-year period. The top sequence of return, no problem. You take your money out, you've got plenty of money, and you end up with more money. Not a problem if the sequence of returns are correct. If we flip-flop those sequence of returns and you're taking that same amount of money out, this $1 million portfolio would be depleted in 22 years. Okay. So we say don't get lulled to sleep. Just because the markets have been good, our clients, when they hit retirement, can't take the same risk level that they could take during accumulation phase. They don't have the time to recover. And all that really means is you don't want to take income off of an asset that's down substantially in value. We have to have time for that to recover. And if we have time, it will recover. But if we're drawing down on assets that are down in value, that's what happens. And most folks don't even address that as they're getting into retirement. This is a snapshot, something we do for every client. And it is our philosophy around retirement income. We call it our impact drawdown analysis. And really, what we're doing here is we're solving for the amount of income that's needed. So when you do proper financial planning, there are different sources of income, Social Security, 401ks, maybe you got rental income, etc. So we really want to dive into putting a plan together that addresses what really is the need. In this hypothetical example, we've suggested that the client needs $125,000 a year of income starting out in retirement. They have about a $3 million portfolio in total, And this is not getting into how much is in 401ks or IRAs or taxable accounts. It's just saying $3 million in general. And what we've said is we want the income side to be certain. So we use principal protected assets. We say principal protected with a reasonable rate of return. These happen to be fixed indexed annuities largely and indexed universal life insurance policies. They are principal protected, meaning when the markets go down, you can't lose capital. Okay. And we have assumed here a 5.5% annualized rate of return from that asset. Okay. And so what we've done is we've said we're going to put 1,250,000 into that principal protected side, and we're going to draw that asset down over 15-year period. So the income bucket where you see the withdrawals coming down, can you see my cursor? No, okay. Now can you? Okay. So that $125,000 a year coming out, you'll notice that the income bucket runs out of money in about year 14 or 15. That's on purpose. Okay. However, if if we've put the maximum amount in long-term growth assets, that 1,750,000, we put this in the growth bucket. We're assuming a 9% rate of return on long-term growth assets. Long-term growth assets excuse me, equities, okay, diversified equity, traditional asset management portfolios. It might be private equity, hedge funds, it might be variable life policies, it might be real estate, but those higher, more aggressive type assets that if we have a 15-year period of time, we are pretty certain we're going to get better returns than we can get on the income side. And in this example, we've set just a 9% rate of return on the long-term growth. So if we've got 15 years, 9% a year, that 1,750,000 grows to about a $5.9 million. Guess what? We've depleted our income bucket and we're still alive at age 76. All we're going to do is take, in this case, 1,550,000 out of the growth bucket and replenish the income bucket. And because of inflation, we've said from that point forward, we're going to take $175,000 a year out. That continues out. Now we've cut some of these rows out just for sake of being able to see it on a slide here. We did that again at age 88. We started taking 250 out at age 88, and this goes on past age 100. The interesting thing here is clients have a really nice visual on solving for income for as long as they live and seeing what that growth bucket ends up being. And that then they can start thinking about what do they want to do with that, the rest of that money, whether it's charity or kids or et cetera. Quite frankly, clients are different. This is hypothetical. We might say we only assume a 7.5% return on long-term growth assets. We might assume we only earn 4.5% on the fixed income assets or the principal protected assets. But you get the positioning here where we're saying let's bucket the monies. And by the way, we use a lot of different vehicles within the income bucket and the growth bucket. So this is just hypothetical. But when we explain this to people, I've shown this to people that have $1 million and who have $50 million. And it makes sense because I go back to that whole thing. There is no retirement without retirement income. So we really need to use assets appropriately. So that is our income impact drawdown analysis. This is a snapshot. This is a bigger presentation, but it's a very similar thing. And we showed clients over a 20-year period or so. We basically showed them a 100% equity portfolio, i.e. the S&P 500. And then we showed them a 50-50, 50% principal protected, reasonable rate of return, and 50% equities, S&P 500. And over this last 20, so this is 25-year period from 2000 to 2025, if clients were taking 40,000 out a year, increasing by 2.5% a year inflation, over the real 25-year period that we've had, we will have drawn out about $1.4 million of income from both portfolios. What's very interesting here, and people don't believe this till we show them the numbers a lot of time, is the all equity portfolio ended up with $106,000 left, and the 50/50 portfolio ended up with $1.1 million left. That goes back to sequence of return and not taking money out and letting your long-term growth assets do what they do, which is recover over time. That's literally another 20 years of income created by doing this impact drawdown investment philosophy. So everyone's different. This is hypothetical, but I think you get the point. When they see the math, clients really start thinking about and are able to provide, are really able to invest the way they need to. Okay. The more money you have, the bigger the portfolios you have, the bigger the consequences are. Generally, the higher your spending needs are, the higher your lifestyle needs are, the larger your required withdrawals are, the higher the taxation is, and the fewer years to recover from early mistakes. So, this is for, in our opinion, everyone who has assets that are in retirement mode. And this gets fairly complicated, and this might be more why people don't do this, is there really is a retirement income ecosystem. And we've got to coordinate complex income sources, Social Security, pensions, deferred comp, investment distributions, IRA, 401k distributions, required minimum distributions, insurance-based income, business income, real estate cash flow. So it can get fairly complicated. And so the better you are at identifying and putting a plan together, the better you can be efficient in that. So insurance, that dreaded word, insurance is not a return engine in our world. It's a risk transfer tool, and it should be treated as such. So whether we're talking about fixed annuities, fixed index annuities, fixed life, index universal life, from the income perspective, insurance companies can do something that you cannot do for yourself, and that is guarantee lifetime income or guarantee principal protection. That is very difficult to do in any other asset, and that's why we are a multidisciplinary company. We don't just do traditional stocks, bonds, mutual funds, money management, private equity. And in our opinion, if you're not utilizing these strategies, you're missing the boat. So, um, so that when we get to, the philosophy around this is design the income first. Start with the lifestyle requirements. What does your portfolio really need to do? And I find this clients have a really difficult time with this. So being able to model that appropriately and ask the hard questions and really understand the situation is not something people do generally on their own. Uh, Coach McCartney used to say, coaching is nothing more than taking people from where they are to where they want to be that they can't do on their own. And that's generally speaking what we do here. It's a coaching philosophy. So start with the income requirements, provide the stability. We've got to offset inflation and taxes, so we've got to grow our money too. Ultimately, most of us have some protection issues and some legacy objectives. And we ultimately, our clients, when they have a plan, if we see a market decline of 10, 20, 30, 40%, they don't call us panicking. Or if they do, we very quickly get them to understand this is part of the plan. We understood that this might happen. And I'll go back to 2007, 2008. In 2007, uh, the markets have been screaming since, so 2003 to 2007, the markets were up dramatically. People were feeling great. I remember very distinctly people thinking about retiring in 2008, 2009. The US stock market was down 51% during the financial crisis. So if you had a portfolio of equities, your $5 million became worth $2.5 million. If you were super concentrated or super aggressive, you might have seen 60, 70% drops. Now, guess what? If you would have held on and stayed in the market, you would have been fine. Or if you would have doubled down after that happened, you would have been great. A lot of people didn't do that because they didn't have a plan in place to meet that. So we don't want that to happen again. Uh, you might be interested in where we've been from a stock market perspective. Basically, we've been in a bull market since 2008, 2009. Has been really good. We will see declines. That's the way the markets work. Is your portfolio ready for those? That's what I would say. So, solving sequence of return risk with intelligent drawdown, in our opinion, is a savvy way to to provide the distributions you need during retirement. Purpose-built income sources insulated from market swings, growth assets positioned for recovery time, flexibility and withdrawals adjusted to market conditions, tax-aware sequencing of distributions. All of those things play into a happy retirement. So what do we want? Confidence. We want clarity, control, continuity. We want to know our income will last. We want to know that our lifestyle is going to be maintained without any guesswork. We want to be super tax efficient. We want to help protect against risks for our family and our legacy. And we want to be able to make decisions proactively, not reactively. So, um, if you're ready to build a strategy tailored to your income, business, and goals, book a strategy with us. A strategy session with Impact Wealth. We'll do generally speaking, an intro call, 15, 20 minutes, and we'll be able to determine rather quickly whether or not we think we can help. And if you like us, then we'll talk about next steps. So always forward this on to anyone you think that might be helped with this. You can reach out to us on our website or email gunner@impactwealth.com or call us. So just book a discovery session with one of our advisors. We're looking forward to meeting you all. Um, and so we will be doing another webinar. We're doing these about every 2 weeks, I think. And the next webinar will be on long-term care or healthcare emergencies. How do you plan for those? And we'll be talking about traditional long-term care insurance. We'll also be talking about hybrid long-term care products and how they fit in with the higher net worth investors. Some of those are life insurance based, and some are annuity based long-term care. We generally don't see people talking about this till their early 60s, mid 60s. It's a pretty unique topic and one that we've found that most consumers really just don't know how to address. They don't know what's out there. They don't know how to integrate it, whether they need it, whether one of these things might work. So that'll be on February 13th, 10 a.m. Mountain Time. So we'll look forward to seeing you all then. So I just want to break real quick. See, do we have any questions from the audience? If you have a question, you can hit chat, I think. Put it in the chat. Is that right?
Yep.
Or raise your hand. Okay, here's one. So someone asked, okay, how do you determine the appropriate size of each bucket? How much goes into the income side? How much goes into the growth side? I would say in general, we are long-term bulls on equities and the stock market. And so and we know that inflation is real. Most of our plans today, we're building out with 3.25% inflation, by the way, going forward. I don't think I mean, if it comes down, great, but inflation's going to be with it. It's always been here. So I really want to get to, do I really understand what the clients need for lifestyle? And when I say lifestyle, it's your daily living expenses. Um, Clients have a hard time understanding how much is going to mortgage, how much is real living expenses, how much are they paying in taxes. It gets very confusing. So really dial into that, provide some margin of safety on that. And then a lot of times they don't even think of, I said, well, you're retiring. What are you going to do the next 2, 3, 4 years? Well, I want to travel. Okay. Do you think you might spend more money? Yeah. Okay. Well, how much? Let's budget it out. Let's say we're going to spend 30,000 a year over the next 5 years and travel. Maybe we should put that in a budget so you're not surprised, right? That mountain house you thought about fixing up or buying. Let's put that in the budget. So we really nail that down. Most people do not do a good job at that. They're kind of flying. We're engineer based, by the way. We're math based. That may sound simple, but for our clients, without the math, I don't know how you plan. Um, so anyway, I think let's get to the what do you really need? Let's provide a margin of safety. And we're saying, okay, if we're going to do that and we draw this down and we know how much what we can do, that really sets the income bucket side. Okay. So that might be 500,000, that might be 5 million, whatever it is that we need to fulfill that bucket size at a minimum. And we're generally going to draw that down over 12 to 16 years. And we know we can get 4.5 to 6.5% rate of returns with principal protection. Once we've got that number, then it's like, okay, we know what you can invest for the long term. How do we do that? And so then we really get into designing portfolios in a comprehensive manner. Oh, by the way, did we talk about expenses in retirement? Oh, what happens if we have a big long-term care need we haven't planned for? What happens if early death or sickness happens? What happens? There's lots of things that people just aren't thinking about. We've got to really build that into a comprehensive plan. So solve for the income need first, put those assets aside. That allows us to maximize the amount of money that we can invest and not worry about from day to day, quarter to quarter. We know it's going to do what we want to do. And clients need some education around that. I think uh, I ask this a lot of times. I ask clients, what do you think? And I use the US stock market mostly for this kind of conversation, but what has the US stock market actually done historically? And generally speaking, I hear 7 or 8% a year. Okay, that's generally what I hear from clients. And I say, would it surprise you to know? And this gets into time periods, but long term, the US stock market's done, depending on the cycle, 10.5 to 12.5% annualized. People don't understand that. And people also don't understand the difference a couple percentage points can make. So, compound interest is the eighth wonder of the world, according to Warren Buffett. So we help them understand if they do certain things and they have a certain time period, this is what they can expect from a real certainty perspective. People don't hear that a lot, okay? They think the market is rigged. They think it's unknown. It's not. It's just a matter of timing and expectations and plan. You getting any more questions? Here's a let me just see, just looking here. Okay, this is a good one. How do RMDs, required minimum distributions, fit into this strategy? Obviously, you've got to take RMDs. We do a lot of planning around retirement accounts. We do a lot of converting retirement assets into tax-free assets. You've got to take your RMDs, and when we get into real planning, we are isolating what how much of the income bucket's going into what, whether it's a 401k IRA or a taxable account. Same thing with other assets. So tax efficiency over time, if you do things right, can add up to a lot of saved money. So that was a good question on RMDs. Um, the other thing I think I saw was so how do taxes play into filling the income bucket over time, repositioning of long-term growth assets? Let me go back to that. This is a hypothetical. Um, this doesn't assume any taxation at all. This is just to help people understand conceptually the reasons why you use principal protected and drawdown assets versus long-term growth. Um, and if we were invested on the growth side and had huge gains, when we go out here to year 15 or 16, when we have to refill the income bucket, we've got to deal with taxation to do that, obviously. And in our plans, as long as we have time, we can plan around that and for tax minimization. But that's a good question. You can't just, it takes some planning. But again, we have 15 years to think about that. So bottom line is, in some respects, the the certainty of the income and the ability to maximize long-term growth. Most people, by the way, like the markets. They just get mixed up. And if they don't have a plan, there's this thing called behavioral finance that gets in their way. This is why people sell at the bottoms and don't get back in until the markets have recovered. So this gives them, in fact, in a lot of ways, this is a behavioral finance issue. So it's not an intellectual issue with normal investing. It's how are you going to deal with money during retirement? And if you have the game plan here, you know what happens when the markets decline. You're much more likely to meet your goals. So, all right, that's a wrap. We are at um, wrapping up here. Again, if you would like to chat, reach out to us, impactwealth.com, Gunner at impactwealth.com. Give us a call. We hope you have a great couple weeks here. And for those of you who join us again, we'll be back on in 2 weeks. Thank you so much for your time. We appreciate you. Hope this was helpful.